Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains, and today we're looking at two of the biggest names left in tech to report their earnings results later this week, and that is Nvidia and Alibaba. We're going to see what to expect from both of those big tech players to see what investors should maybe do with these stocks this week. But before we get into everything, I want to say, remember, if you have any questions or episode suggestions, please feel free to shoot us an email over at podcast@zacks.com. Also, make sure to subscribe and leave a review wherever you listen to your podcasts. And make sure to check out our new Zacks.com/promo page for a look at some of our services, portfolios, and more. All right, so before we jump into Nvidia and Alibaba, it's worth diving quickly into the market to get a sense of what's going on and what might be happening this week. So U.S. stocks surged on Monday with the Dow and the S&P 500, both up over 3% through morning trading on Monday. The gains today wiped out last week's losses that saw the S&P 500 slip about 2.3% on the back of some disappointing but pretty expected data that showcased the sharp drop in economic activity in the U.S. and elsewhere amid all of the coronavirus economic shutdown. This positivity, so on Monday, this positivity came as Moderna, which is a company that has been working on a vaccine for the coronavirus, said that it had positive results from early human tests of its vaccine. Meanwhile, economies around the world are starting to slowly reopen. And on top of this, it seems likely that we remain in a broader don't fight the Fed mode, given that the central bank and the U.S. government seem poised to do all they can to boost the economy and the markets at the moment. And then we had Jay Powell speaking last night on 60 Minutes, and he helped further spark this faith, saying to CBS that there is, quote, "There is no limit to what we can do under these emergency powers." CBS then followed up saying, "Where does the money come from?" And Powell, sort of jokingly, maybe not jokingly, said, not in jest, because it's true. He said then, "We print it digitally." So they're going to be supporting the economy and the markets for as long as they need to be. So with this in mind, though, the earnings data remains rough. So as of last Friday, May 15th, we had seen Q1 results from just over 450 S&P 500 members, or about 90% of the total membership. And of these members that have already reported earnings were down just over 11%. And then if we look ahead, the second quarter is hopefully where the worst of the coronavirus results are, with the bulk of that coming during that 3-month period, because most of these results for Q1 only include about a couple, maybe 3 weeks of their coronavirus, since those reports are mostly from the 3 months that ended on March 31st. So with that said, Q2 earnings are projected to tumble about 42%, with the full year earnings for the S&P 500 projected to sink 23%. So Q2 far worse than what we're expecting and what we've seen so far in Q1. So with that said, stocks could clearly fall again, or they could break out of their current trading range that they've been stuck in for some time now, on the back of all of these future-looking things, such as the economy returning to normal and the possibility of a vaccine. But with that in mind, investors should still be looking for stocks that appear to be able to grow during the coronavirus and within solid industries, and clearly tech, with giants like Apple and Microsoft, and even fresher faces like Zoom, proving that they're able to remain sort of safe haven style investments that are able to grow during the coronavirus economic downturn. So with this in mind, we're going to take a look at the two companies we're talking about today, which is Nvidia and Alibaba. And we're going to start with Nvidia, since they report before Alibaba does this week. So Nvidia's fourth quarter results impressed Wall Street all the way back in February, with the GPU powerhouse once again showing its ability to expand its data center in cloud computing business. Shares of Nvidia have surged roughly 50% in 2020 against the S&P 500's 11% decline. And Nvidia's outlook remains pretty strong despite the ongoing coronavirus economic downturn. This means we should see what's going on with the company, and we should also note that for anyone interested, they do report after the closing bell on Thursday, May 21st. So you have until then to decide what to do with the stock, if you're going to try to play it around earnings or if you're going to buy it as a longer term investment. So with this in mind, Nvidia is a GPU giant, and it will continue to play a large role in the global gaming industry that is projected to grow from about $150 billion in 2019 to roughly $200 billion by 2020. Last quarter, their gaming unit sales climbed 56% against an easier to compare period and accounted for roughly 50% of total revenue. So over 56% growth, accounting for about 50% of Nvidia's total revenue. And then on top of that, its data center division jumped 43% to a new record of nearly $1 billion, and it crushed analysts' estimates. The company's growth within this vital cloud computing and data center market has captured Wall Street's attention because Microsoft and Amazon and these other big cloud players have proven that cloud probably is the future, especially in the near term. And then on top of that, you had fellow chip firms like Intel and AMD report solid results in their data center businesses in the fourth quarter. So then overall, Nvidia is still subject to the cyclical nature of the broader semiconductor industry, even though it's expanded its portfolio with a presence in everything from artificial intelligence to 5G and autonomous vehicles and more. But with that said, they're obviously still in that cyclical business. And we should note that on the company's fourth quarter earnings release, which came out on February 13th, they lowered their Q1 revenue outlook by $100 million to account for the potential impact of the coronavirus. It's also worth remembering, though, that guidance came well before the coronavirus turned into a global pandemic that shut down large chunks of the economy. So what they report this Thursday could provide much better ideas of how the coronavirus actually impacted them and what it might do going forward. And we should also note that Nvidia, during this time, has officially closed its $7 billion acquisition of Mellanox to create a more robust firm. So the deal is its largest ever, and it's made to help bolster its data center expansion. This is from the press release saying, our combined expertise, supported by a rich ecosystem of partners, will meet the challenge of surging global demand for consumer internet services and the application of AI, accelerated data science from cloud to edge to robotics. And this is from Nvidia's CEO in prepared remarks at the end of April. So that big $7 billion acquisition was officially completed. And now we're going to take a look at some other fundamentals before we look at what to expect. So we should note that Nvidia stock has soared over 130% in the last year, and it broke out above its fall 2018 highs earlier in the year after suffering a relatively extended sell-off. In fact, it hit new 52-week highs on Monday of over $356 per share. With that said, its valuation picture has grown a little stretched, as might be obvious given this big run. With that said, it's still trading below its 3-year highs in terms of forward 12-month sales estimates. So it's trading at about 14.9 times forward 12-month sales, and it's traded at as high as around 15.5. So still some more room to expand there on the valuation side as people drive up the stock price at the moment. And on top of that, Nvidia also does pay a dividend, and its balance sheet remains pretty strong. So at the end of fiscal 2020, so their last year, they closed with roughly $11 billion in cash and equivalents against just $2.6 billion in debt. So now we're going to go ahead and take a look at what to expect. So our current Zacks estimates are calling for Nvidia's Q1 fiscal 2021 revenue to jump roughly 35% from the year ago period to $3 billion. It is worth remembering that Nvidia's sales fell 31% in the year ago period, with its full year revenue down approximately 7% last year. And that's part of that cyclical semiconductor business. So we're calling for 35% growth against an easy year to compare Q1 of last year. And with this in mind, we're expecting then another 28% growth the next quarter. And for the full year, we're calling for about 22% revenue expansion, and then another 16% that following fiscal year. So some solid growth amid a lot of uncertainty. And then on the bottom line, things look even better. We're calling for its adjusted Q1 earnings to jump over 92% to $1.69 per share. And then this growth is expected to continue in Q2, about 49% bottom line growth for about 30% bottom line growth in its current fiscal year, and another 20% growth that next year. So clearly their outlook looks solid on both the top and bottom lines, and it also has a strong history of quarterly earnings beats. It's topped our quarterly earnings estimates by about 11% over the trailing 4 periods. It also holds a Zacks rank number 2 buy at the moment, alongside an A grade for growth and a B for momentum in our style score system. And it's part of an industry that rests in the top 26% over more than 250 Zacks industries. So that's always a good sign to be part of a strong industry, especially amid these unprecedented and uncertain economic times. So with that said, anyone who's looking to buy Nvidia in the near term, it's always a tough play, especially, as I said, amid all of this uncertainty. But longer term investors might want to consider buying Nvidia even at these new highs. It's a growth focused chip stock that's prepared to expand within cloud computing and gaming, which are both not going anywhere anytime soon. In fact, they're probably going to get much more popular. It also pays a dividend, but in the near term, it could certainly slip if it fails to impress Wall Street on Thursday or provides any downtrodden guidance amid all these coronavirus concerns. But longer term investors might want to consider buying Nvidia even near these new highs, because in a year from now or a couple of years from now, it's going to most likely look that Nvidia was at a cheaper price now than it will be in several years from now. So with that in mind, we're now going to take a look at Alibaba. They trade under the ticker BABA, so BABA. So their stock has lagged the broader e-commerce market in 2020 and is well behind the S&P 500's climb from its March 23 lows as well. So clearly it seems like Wall Street is a little worried that the coronavirus will hurt the Chinese e-commerce giant in the near term, even though things have slowly returned to something close to normal in the world's second largest economy. And before we look ahead, it's worth noting that Alibaba is set to report its March quarter and full year fiscal 2020 results before the market opens this Friday, May 22nd. All right, so now we're going to go ahead and take a look at the broader picture and then what to expect from Alibaba going forward, and see if maybe it's worth buying Alibaba stock. So Alibaba reportedly controls roughly 2/3 of the Chinese e-commerce market, and its growth in recent years has also come from expanding into smaller cities, and in China, smaller cities that are still millions of people. And this is happening as the Chinese middle class continues to explode. So based on McKinsey estimates, China's middle class could hit about 550 million people by 2020, which is far larger than the entire US population of about 330 million. So their ability to reach these smaller cities and sell products to a growing middle class in China could continue to help Alibaba grow for years, if not decades to come. So last quarter, the company's annual active customers across its Chinese retail marketplace hit 711 million people, and its mobile active users jumped by about 40 million from the quarter before to 824 million. So those are the active users. 824 million monthly active mobile users across Alibaba. This helped Alibaba's quarterly revenue climb about 38%. And we should note that is they'll report their results in their currency, and then they'll also provide the U.S. translation to U.S. dollars. So they climbed 38% to just over $23 billion. And this captured the 3-month period that ended on December 31st. So obviously that didn't really include any significant coronavirus impact. And we should note that their core commerce business accounted for about 88% of these total revenues. With that said, Wall Street and investors have continued to take note of Alibaba's investment and expansion in its own cloud computing business, as we mentioned with Nvidia, that Amazon and Microsoft and all these giants have climbed to new highs really on the back of their cloud computing growth as well. So with that said, their cloud computing revenue climbed 62% last quarter and accounted for about 7% of overall revenue. On top of that, it also has a digital media and entertainment business, which climbed about 14%. And they're trying to produce more original content that, quote, resonates with Chinese audiences. And investors should note that one of the only places where Netflix doesn't have a presence and a lot of these other big US companies don't have a presence is within China. So they will have less competitors in this streaming TV entertainment space for the at least foreseeable future. And then on the pandemic front, we're going to now take a look at what to expect with a quarter that's going to hopefully, for Alibaba's sake, include its worst coronavirus hit of the year. So with this in mind, our Zacks estimates call for Alibaba's quarterly sales to climb just 9.7% from the year ago period to come in at about 15.3 billion. So this would mark by far its slowest top line growth as a public firm. It went public in the US all the way back in 2014 at this point. And then on the earnings front, its adjusted earnings are projected to tumble over 31% from the year ago period to about 88 cents per share. So despite these projected near-term setbacks, Alibaba is projected to return to stronger growth next quarter, with adjusted fiscal year earnings per share still expected to climb about 28%. So in fact, the pandemic could, in the long run, help speed up its e-commerce growth in China and elsewhere. So it might take a near-term hit for the coronavirus, but this could then help speed up this transition to e-commerce retail for years to come. So then looking ahead, Alibaba's quarterly outlook appears, as we said, pretty rough during these unprecedented times. Plus, China might, though, at this point, have a lot of the coronavirus in their rearview mirror at this point, with the full impact likely not felt until Q2 for many US companies. So therefore, investors might want to start considering Alibaba as kind of a safe haven, stay-at-home play with tons of longer-term potential that might already be on the other side of the coronavirus as China returns to something close to normal, as we mentioned before. So like Nvidia, Alibaba is currently a Zacks rank number 2 buy, and it sports B grades for both value and growth in our style score system. And it's currently trading at about 5.2 times forward 12-month Zacks sales estimates. So this comes in well below its 12-month highs of about 8.5 and trades at a huge discount against the likes of Microsoft, which is trading about 9 times forward 12-month sales at the moment. And the company is also part of a highly ranked internet commerce industry, and Baba shares still sit about 10% off their highs heading into earnings, which could give them room to run if the e-commerce powerhouse is able to impress its results or its guidance. And as with Nvidia, the near term still obviously very uncertainty in diving into any stock at this point. All in might be a little unwise, much less a retailer in China. So maybe if you're considering buying Alibaba, take a smaller position in it and see what it does in the near term. But any longer term investors might want to consider Alibaba now and going forward. So before we close today, we should note that Alibaba jumped about 5% through morning trading, and Nvidia was up about 3.5%. So both strong starts to the week, along with the broader market starting strong. So we have these two big tech company results out later this week, and both companies do look positioned to grow in the long term, and obviously their near term remains uncertain. So longer term investors might want to consider it, and then more risk taking investors who are trying to make some near term gains might want to consider taking further look at both Nvidia and Alibaba before making any of those moves. So that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions or episode suggestions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.